Imagine this, turning a tiny investment, maybe just pocket change, into a real fortune. Or, just as easily, watching it all disappear, almost instantly.
Yeah, that's pretty much the world of penny stocks, isn't it? High stakes, high risk.
Definitely. And today we're diving deep into an ebook called Pennies to Fortunes. It's designed to, well, get you up to speed fast, but also, maybe more importantly, protect you in this market.
Right, because our mission here is really to give you a shortcut,
Yeah.
a way to understand this exciting, yeah, but super risky world beyond just the crazy headlines.
And the first thing that really jumps out from this book is a huge warning. It talks about scams and bad information reaching epidemic proportions.
It's stark, isn't it? It's not just about stocks going up and down. It's about actual dishonesty, people actively trying to mislead you.
Exactly. So this deep dive is aimed squarely at helping you avoid those traps.
So where do we start? The book lays out a clear path.
Yeah, first, we hit the absolute don'ts. The things you just cannot do if you want to survive. Then we'll get into some maybe surprising truths and basic ideas to trade smarter.
And after that, some more advanced stuff.
Right. The secrets, the advanced strategies. And finally, we'll point you to some really good resources the book recommends, ones that actually cut through the noise.
Okay, sounds like a plan. Let's kick off with those critical 3 don'ts. The book defines penny stocks as anything under $5 a share. Right.
Yeah, that's the general definition used here.
It's really strong on this point.
Yeah.
Most of the money people lose, it's because they break one of these 3 rules. It's like, rule number 1 is don't break the rules.
Okay, so what's the first cardinal sin? Lay it on us.
Number 1, never follow free stock reports.
If
Ever.
Okay, the book asks, why are they free? What's their angle? How do they even afford it? But let's, dig a bit deeper. How do these actually cost you money?
Well, often it's because the company being featured in the report is paying for it. It's not research, it's an ad.
Ah, so it's a pump. They pay someone to write a glowing report to get the price up.
Exactly. Which leads right into don't number 2. Never give your email address to a free stock pick website.
Why not? Seems harmless enough. Maybe get some ideas.
The book says it will come back to haunt you because now they have your email and they can flood you with those same paid promotions. You get trapped in their hype cycle.
Okay, makes sense. Free reports, free emails.
What's don't number 3?
This one's big. Never buy pink sheet penny stocks.
Now, that is interesting because I think a lot of people, maybe even experienced investors sometimes, think the pink sheets are just, another stock market.
Right. But the book is crystal clear.
Uh.
They are not a regulated exchange like the NYSE or NASDAQ.
Yeah.
Not even close.
And that lack of regulation, what's the real danger there? Beyond just, losing money.
It's the Wild West. No strict reporting rules, no real transparency. You often have no idea if the company is even real, let alone healthy.
So you could literally be buying into nothing. Pretty much. The book warns they could leave you penniless. They're ripe for scams and manipulation.
Okay, so avoid free reports, don't give out your email to those sites, and stay away from pink sheets. Got it. So, if you do want to trade penny stocks, what should you look for?
Quality. High-quality companies. Sounds obvious maybe, but in this space, it's crucial. Strong fundamentals, good financials, competitive advantages, maybe patents, growing market share.
Things like actual cash flow, manageable debt, real profits, even for these tiny companies.
Yes, exactly. Applying that kind of rigorous analysis. And competitive advantages could be a patent, or maybe just dominating a really small niche market.
That sounds like a lot of work, finding those needles in the haystack.
It is. The book says it's a tremendous amount of work, but also well worth it. It lays out 2 options, basically.
Do it yourself, or
Rely on professional analysts. But, and this is but the book gives a massive warning here.
Oh, about the professionals.
Yeah. It states flat out that the vast, vast majority of penny stock newsletters are paid by the companies they cover. Bump and dumps, essentially.
Wow. So they're not working for the investor, they're working for the company they're recommending.
Precisely. Their goal is to get the price up so they or the company can cash out, often leaving regular investors holding the bag.
So how do you find someone trustworthy?
You absolutely have to look for sites that offer a 100% unbiased guarantee, meaning they take 0 compensation from the companies. Their picks have to be genuinely in your best interest.
It really sounds like navigating a minefield.
It can be.
Yeah.
But the book also shows the flip side. What happens when you get it right? It gives the example of Absolute Software, ticker ABT.
Yeah, I saw that Leeds Analysis recommended it.
Right, recommended at 80 cents. The example says a $2,100 investment ballooned to $105,000. And one person apparently made $500,000.
Okay, that's the potential payoff people dream about.
It is. But notice, it came from following unbiased analysis and avoiding those major pitfalls we just discussed. It's not just luck.
Which is a perfect segue into the next part, right? The learning lines, foundational concepts you need to grasp.
Exactly. These are the basics. But getting them wrong can totally sink you, even if you pick the right stock.
First up is averaging down. I think a lot of us have been tempted by this one.
Oh, for sure. It sounds logical, right? You buy a stock at $1, it drops to 50 cents. You buy more. Now your average cost is only 75 cents. Seems smart.
The book uses the example of DUD stock. 1,000 shares at $1, then a 1,000 more at 50 cents. Total cost $1,500 for 2,000 shares at an average of 75 cents. Math checks out.
The math works, but the book argues it's usually a huge mistake. Why?
It says you're basically trying to minimize a past mistake, throwing good money after bad.
Right. You're pumping more and more money into a sinking ship. The core idea it violates is preservation of capital. Protecting what you have should be priority number one.
That first loss is your best loss idea. It's hard to swallow sometimes, but it makes sense financially.
It does, and it ties directly into the next point. 6 stock market math.
Oh yeah, this part was eye-opening. If your stock drops 50%,
You need a 100% gain just to get back to even.
and if it drops 75%,
You need a 300% gain. 300%.
oof, that really drives home the point, doesn't it?
It hammers it home. The lesson is crystal clear. You cannot afford to lose money carelessly. This cold truth, as the book calls it, is what happens when you ignore those 3 don'ts.
It's a brutal reality check. Okay, another trap the book flags is reverse splits.
Yeah, we know normal stock splits, right?
Mhm.
Companies doing well, splits 2 for 1, price adjusts, often seen as positive.
Right, but a reverse split.
It's the opposite, and the book calls it evil, almost always a sign of company in trouble.
Why do they do it then?
Usually to artificially boost the share price, maybe to stay above $1 to avoid getting delisted, or look more legit, maybe try to move to a bigger exchange.
So like a 1 for 10 split. 10 shares become 1 share. Price theoretically multiplies by 10.
Exactly. But the trick, the book explains, is that investors who aren't paying close attention might see a stock suddenly trading at, say, $2 when it used to be 25 cents.
And they think, wow, this thing is taking off.
Right, when actually the company just did a reverse split, and the value might even be lower than before. The example given shows a $2.74 price post-split might actually require getting to almost $125 for original investors just to break even.
That's incredibly deceptive.
It really is, and the book basically says, look, most people don't do their homework, their due diligence, but you, the listener, armed with this knowledge, you can.
Good point. Okay, let's shift gears to selling. Sell, 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 as the section heading puts it.
Interestingly, the book starts with a contrarian idea here. It says your profit is made when you buy right, not when you sell. Selling is just, closing the loop.
Okay, but it still gives selling pointers, right?
Absolutely. First big one, lock in profits. Don't be afraid to sell just a portion, maybe half, maybe a quarter, even 10%, and let the rest ride.
Reduces risk, keeps some skin in the game. Makes sense. What else?
Avoiding regret. There's a personal story in there about selling for nearly 10x gain at $8.
Only to watch it shoot up to $40.
Exactly.
Yeah.
And feeling like it was a major loss, even though it was a huge win on paper, that fear of missing out, that greed, it's powerful.
Yeah. Emotion is a killer in investing.
Definitely. Which leads to understanding different types of price increases. Slow, steady gains are usually more sustainable.
Compared to those sudden, sharp spikes, like the DCSR example.
Right, those rapid spikes can make overnight millionaires, but they often crash just as fast when the hype fades. Sustainability is key.
So how do you spot the real potential winners? The life changers, as the book calls them. The ones that give those massive, quick, stunning price gains.
It's not about settling for the usual 30–50% profit target.
Yeah.
You're looking for signs of truly unlimited upside potential.
Like what? What are those signs?
Maybe the company has a tiny slice of a massive booming market. High barriers to entry for competitors, strong patents, growth that's not just growing, but accelerating.
Okay, find that potential, then what?
Then you gotta keep checking in. Constantly. Call the company, we'll get to that, reread the financials, watch the trading volume, ask yourself, is the story still compelling today?
And even then, maybe take some profits along the way.
Yeah, the book suggests taking partial profits is smart, even if you think it's going higher, like people who held Microsoft long-term but maybe trimmed positions occasionally. It mentions Forward Industries, F4D, as an example of a massive win, 2,885% profit.
Wow. Okay. And you mentioned calling the company. That leads to another point, right?
Yes, this one's great. They're waiting for your call. It's about investor relations or IR.
Public companies have people whose job it is to talk to investors.
Exactly. Their job is literally to answer your questions. But the book says hardly anyone, especially small investors, ever actually calls them. It's hugely underutilized.
Really? Why not? Seemed like a direct line to information.
People might be intimidated or just don't think of it. But it's easy, it's free. And a 15-minute call could genuinely give you insights worth thousands of dollars.
What kind of questions should you ask?
Things like, what's the outlook for the next year? 3 years? Who are your main competitors, really? What could drive the stock price up or down soon? Any M&A chatter. Revenue guidance.
You're listening for clues, for the nuances, the hidden gems.
Exactly. It leads to much better clarity about whether your investment thesis holds water.
Okay, that's a really practical tip. So we've covered the don'ts, the learning lines. Now we move into the penny stock secrets.
Right. These are positioned as more advanced strategies. Timeless, effective, and certainly not widely known, according to the book.
Sounds intriguing. What's first?
Buy the rumor, sell the fact.
Ugh.
It's a classic market saying, but apparently very powerful with penny stocks.
How does it work? People buy based on anticipation.
Right. A rumor starts, maybe FDA approval coming, a big contract, whatever. Speculators pile in, driving the price up before the event happens.
And then when the actual news hits, the fact.
The buying pressure often dries up. People who bought the rumor start selling to lock in profits, so the price can actually fall on the good news because it was already priced in.
Huh. So the smart play is to potentially sell before or right when the news breaks.
That's the idea. The book uses an example of ABC Inc., waiting for FDA approval. Price runs up beforehand, then stalls or drops when approval is announced because the news is out.
What makes a rumor tradable like this?
It needs to be pretty widely known. The probability needs to feel like it's increasing, has to be significant news, and the date needs to be getting closer.
The book gives the Exum Sirius merger example, right? That was huge.
A perfect example. Widely followed rumor. Shares ran up to $2.75 based on merger anticipation.
But then the merger actually got approved, July 2008.
And the stock collapsed. Within 5 months, it was down to 11 cents. The speculation bubble burst, and the ugly reality of their debt took over. People who sold the fact did much better.
Wow. Okay, buy the rumor, sell the fact. What's the next secret?
This one's about psychology. Investor sentiment is trying to fool you.
Meaning the overall mood of the market, optimism versus pessimism.
Exactly. But the key insight is that widespread sentiment is often a contrarian indicator.
So if everyone is super bullish and optimistic,
The market's probably heading for a fall. Think the dot-com bubble peak.
and if everyone is incredibly pessimistic, gloomy, saying the sky is falling,
That's often when the market is actually bottoming out and about to head higher.
why does that happen? Why is the crowd usually wrong?
2 main reasons given. 1, historically, most individual investors do tend to get it wrong. They buy high near the tops out of euphoria and sell low near the bottoms out of panic.
And the second reason?
It's about buying and selling pressure. If everyone who is optimistic and wants to buy has already bought, there's no one left to push prices higher. The buying power is exhausted. Same logic applies on the downside with selling pressure.
So you need the courage to go against the herd.
Precisely. The book says it takes a lot of courage to buy when everyone else is selling, but the harder it becomes for you, the more likely that you are making the right move.
That's a powerful thought. Okay, next up, limiting losses. This seems fundamental.
Absolutely essential, especially in penny stocks. The book acknowledges, look, losses and risk will always be there. You can't eliminate them entirely.
So how do you manage them? What are the strategies?
Well, first, maybe controversially, it suggests investment abstinence. If you truly cannot afford to lose the money, just don't invest it in something this risky.
Fair enough. Assuming you are investing, then what?
Only invest when you're comfortable, when you really understand why you're buying, what your price target is, and crucially, what your exit point is before you even buy.
Plan the trade, trade the plan, avoid getting emotional.
Yes, don't fall in love with the company. Focus on fundamentally strong stocks to begin with. Use paper trading, simulated trading to learn the ropes without risking real cash.
Diversification is mentioned too, right?
Definitely, don't put all your eggs in one basket. Diversify by industry, maybe market cap, even geography, if possible.
And stop losses.
Crucial. Use stop-loss orders, or at least have firm mental stops, where you say, if it drops to X price, I am selling, period. It protects you from catastrophic losses.
What else helps limit losses?
Look for stocks with decent trading volume so you can actually sell easily when you need to. Take partial profits along the way that proactively locks in gains and reduces your risk.
And using limit orders, not market orders. Why is that so important for penny stocks?
Because penny stocks can be thinly traded. A market order just says sell now at whatever price. In a thin market, that price could be way lower than you expect in the instant it takes to execute. A limit order says sell only if I can get at least this price. Gives you control.
And finally, it reiterates trading on better exchanges, not the pink sheets.
Right. OTCBB, NASDAQ, AMEX, NYSE, they have stricter listing requirements and generally better liquidity.
Okay, that's a lot of good practical advice on risk management. Now, the scales of investor justice, what's that about?
It's about scaling in and scaling out. Basically not buying or selling your entire position all at once.
Which less experienced traders tend to do.
Yeah. Experienced traders, the book says, often scale in, they buy in pieces, maybe over days or weeks, and they scale out when selling.
What's the benefit of scaling in? Buying in chunks.
It keeps you flexible. You don't commit all your capital at one price. You buy some, see what happens. If it goes up, great, you're in profit. If it goes down, you have cash left to potentially buy more if you still like the company, lowering your average cost selectively.
Buys you time to assess, keeps options open. The example uses a $6,000 investment, maybe putting in $2,000 first.
Exactly. Yeah, commissions might be slightly higher doing multiple trades, but the book argues the risk management benefit makes it not a big deal.
And scaling out, selling in chunks.
Same logic. Avoids dumping all your shares at once, which could slam the price down, especially in a less liquid stock. You can spread sales out over time, or maybe sell pieces before and after expected news events.
More control, less market impact. Okay, one more secret. Trading windows.
This is about timing. The idea is that most of the really big moves in penny stocks, up or down, happen in very short periods, weeks, days, even hours.
Usually triggered by news.
Yeah, significant news is the trigger. So the strategy is about anticipating these windows of opportunity or high risk.
How can you anticipate them?
3 ways suggested. First, consider the type of company. Biotech waiting on FDA news is way more prone to sudden moves than, say, a small retail chain. Know the industry's rhythm.
Okay, understand the sector's catalysts. What's second?
Volatility indicators. Get a feel for it from charts. How wide is the price range over the year? How fast does it move? Or use technical measures like beta.
Beta, how does that work?
Beta measures how much a stock tends to move relative to the overall market. A beta of 1 means it moves with the market. A beta of 3 means it's typically 3 times more volatile. Higher beta suggests bigger potential swings, bigger windows.
Got it. And the third way to anticipate windows.
Anticipate the actual releases. Financial results have predictable dates. Biotech companies often publish timelines for clinical trials or FDA submissions. Knowing these dates helps you prepare for potential volatility around them.
So you can position yourself before the expected move rather than just reacting afterwards.
Exactly. It's about being proactive based on likely catalysts and volatility.
Okay, those are some powerful advanced concepts. Now, the book also includes curated resources.
Yes, and this is really valuable. It acknowledges the absolute ocean of confusion and misinformation out there, especially online. So much noise.
And most of it unreliable, right?
Right. So this section highlights specific, handpicked resources, videos, articles, press releases, blog entries that the author believes really stand out and can make you a superior investor.
It's not just a random list, it's curated. Things like 3 keys, which the best penny stocks have in common, or the stock market has reached an encouraging capitulation point.
Yeah, or blog posts like systemic versus non-systemic risk. These aren't just stark tips. They're resources to help you think better about the market and risk, a shortcut to quality information.
That's incredibly useful in itself, cutting through the clutter. Okay, so let's try and wrap this up. We've covered a lot.
We really have. Our goal today, taking insights from pennies to fortunes, was to arm you with knowledge. Protection first, through those 3 don'ts.
Right, then understanding key concepts like why averaging down is risky, the brutal market math, how reverse splits work.
Then strategies for selling smartly, finding potential big winners, even using investor relations.
And finally, those advanced secrets. Buying the rumor, using sentiment as a contrarian tool, limiting losses systematically, scaling in and out, and timing those trading windows.
It's a comprehensive toolkit, really.
Absolutely. But we absolutely have to reiterate the warning, the disclaimer that's also in the book. Trading stocks, especially penny stocks, involves significant risk.
Huge risk. And nothing we've discussed today is investment advice. It's purely for educational purposes, based on the source material.
We're not advisors. You should always, always talk to a qualified stockbroker or financial advisor before making any decisions with your own money.
You assume the entire cost and risk of any trading you decide to do. That's crucial to understand.
Definitely. So maybe a final thought to leave our listeners with.
Well, in a world that pushes quick fixes and following the crowd, this deep dive really highlights something else, doesn't it? The power of doing your homework, of patience, of being willing to think differently, maybe even contrarian.
So the closing thought could be, what other parts of your life, beyond just investing, might really benefit from that same kind of careful research, strategic thinking, and, well, the courage to swim against the tide?